Hey everyone, and welcome to AI Explains ICT. Today, we're diving deep into some really cool material from Core Content, Month 9, Episode 2. We're going to be talking all about a powerful framework that ICT calls filling the numbers. This is the holy grail for any day trader, right? What if you could actually figure out where the daily high or low is going to form before it even happens? Well, according to ICT, there's a method to the madness, and it all starts with a surprisingly simple pattern you can see in the market pretty much every day. And that magic number is 4. The core idea, the big takeaway here, is that the algorithm that drives price action isn't just wandering around aimlessly. It has a job to do. And part of that job is to trade to 4 specific price levels each and every day. That's what filling the numbers is all about. The daily range has a target, a kind of daily quota it needs to hit. Okay, so if the market is hunting for 4 levels, the big question is, what are they and how do we find them? Well, the most basic starting point, the one everyone knows, is the previous day's high and low. You can think of those as the big obvious landmarks on our map for the day. But to really zero in, we need to pull out our first tool from the toolbox. And that first tool is going to be floor trader pivots. Now, I'm sure a lot of you have seen these on your charts before. They're a classic for sure, but here's the thing. We're not going to use them like most retail traders do. We're going to look at them through a completely different institutional lens. So here's what they look like, the standard layout. You've got your central pivot right in the middle, then you have your resistance levels, R1, R2, R3 stocked on top, and the support levels, S1, S2, S3 down below. But, and this is important, look closely at those M levels. Those are the midpoints between the main pivot lines, and you absolutely cannot ignore them. They are just as juicy of a target for the algorithm as the main levels are. And this is really the secret sauce right here. We are not looking at these as places to buy or sell. Like buy at S1 or sell at R1. That's the old retail way. Instead, ICT teaches us to see these levels as places where big institutional orders are just sitting there, waiting. They're staged. And that means there's a ton of liquidity at these prices. The algorithm, or the IPA as ICT calls it, is designed to hunt for that liquidity. So these levels become powerful magnets for price. So how do you actually use this? It's a pretty straightforward process. Step 1, and this is non-negotiable, you have to have a directional bias for the day. Are you bullish or bearish? If you're bullish, you start looking for 4 pivot levels in a row above where you got in. If you're bearish, you're looking for 4 levels below your entry. And once price ticks off that 4th level, boom, that's your signal. That's where you take the bulk of your profits. Okay, so floor trader pivots are a fantastic starting point, a great foundation. But now we're going to get into the really unique stuff, the tools that are specific to the ICT arsenal. These are designed to project the daily range from a truly institutional perspective. And first up, we've got something called the Central Bank Dealers Range. The Central Bank Dealers Range, or CBDR for short, yeah, you're not going to find this one in your average trading book. It's a very specific ICT concept. The whole idea is to pinpoint a particular price range that forms early in the day. And once you've got that range locked in, you can use it to project standard deviations out. And guess what? Those projections give us our 4 potential targets for the day. Let's break down how this works. Say you're looking for a short trade. First, you mark out the low of that CBDR. The second price trades through that low, you count that as hitting target number 1. From there, it's pretty simple math. You just take the size of that original CBDR range and project it downwards. That first projection is level 2. The next one is level 3. And the one after that is level 4. And if you're looking for a long trade, you guessed it. You just flip the whole thing on its head. And check out this chart. It's a perfect example of this playing out. You see the short entry is taken up above the range. Then price breaks the low of the range. That's our level 1 right there. And then just look at it. The market just marches down almost like it's on a schedule, hitting level 2, and then 3, and finally hitting level 4. A perfect filling of the numbers. All right, next up in the toolkit is the Asian range, and you'll see this works on the exact same principle as the CBDR. We're going to identify a specific range and then use that range to project out our 4 targets. The logic here is rock solid and consistent. For a buy setup, you're looking for an entry below the Asian range. When price punches up through the high of that range, you count that as level 1, and then you project 3 more levels up from there. For a sell setup, it's the mirror image. You want to get in above the Asian range. When price breaks the low, that's your level 1, and you project 3 more levels down. Okay, now we're going to get into what might be the most advanced and definitely the most unique projection method we're going to talk about today. It's called the flout. So, what is the flout? It's all about a very specific time of day. It's the price range that gets carved out between 3 p.m. and midnight New York time. That range is our starting point. But the way we use it to project our targets? Well, it's a little different from the other tools we've looked at. Okay, you're going to want to lean in for this one because it's a little quirky. First, you identify that whole range from 3 p.m. to midnight. Got it? Next, you slice that range right down the middle. You find its 50% equilibrium point. Now, and this is the key, you are not going to project the entire range. Nope. The unit you're going to project is just half of that total range. You take that 50% section and project it 4 times to get your targets. Let's make this real and look at a chart. So you see here the total flout range is marked out, and then it's cut in half. In this short trade example, price breaks down through that halfway point. The original low of the range becomes our level 1. Then you just take that same 50% measurement and project it down again to get level 2, do it again for level 3, and one last time for level 4. It's incredibly precise, isn't it? So, by now, I'm sure the question bubbling up in your mind is, okay, this is great, but which one do I use? Do I use the pivots, the CBDR, the Asian range, the flout? And that is the perfect question to ask. The answer, my friends, is all about bringing them all together. It's about synthesis. And as ICT himself says, you just never know for sure, before the day even starts, which one of these tools the algorithm is going to use to do its work. The market has to show its hand as the day goes on. So your job isn't to pick a favorite tool and stick with it no matter what. Your job is to listen and watch for when these different tools start to agree with each other. And that right there is the heart of high probability trading. Seriously. Using just one of these tools by itself, it's basically a coin flip, it's a guess. But when you have 2, 3, or more of these independent tools, all pointing to the very same price level, well, now you've got something. Now you have a real strategy. That is the power of Confluence. And Confluence doesn't stop with just these range tools. The real magic happens when you start layering them with everything else you've learned. We're talking about the PD array matrix, things like order blocks, fair value gaps, you name it. And of course, the time of day is absolutely critical. When you get the range projection, a key PD array, and the right time of day all lining up, that's your A-plus setup. That's when you can confidently target the daily high or low. Look, all this theory is fantastic, but let's see how it all clicks together in a real-world trade. ICT provided this example, and it led to an almost unbelievably precise call on the daily high. Okay, so take a look at this Euro chart. The call was for the daily high to form right around the 1.0930 level. And just look at what happened. Price rallied up with surgical precision, tagged that level almost to the pip, and then reversed. It's beautiful. But the question is, how on earth was that level identified ahead of time? This is where it all comes together. Check this out. First, there was a fair value gap, a key PD array, sitting right around that 1.0930 level. That's one piece of the puzzle. At the same time, a totally separate analysis using the floor trader pivots showed the M5 pivot level was at 1.0933. You see that? We have 2 completely different tools pointing to the exact same 3 pips zone. That is the kind of powerful confluence that gives you the confidence to call a daily high. So, you see, mastering the daily range isn't about finding one secret magic indicator. It's about doing the work. It's about layering all of these concepts, taking the measurements every single day, and then having the patience to wait for that beautiful confluence to show up. But when you do put in that effort, man, the reward is a framework that can help you anticipate the market's moves with a whole new level of clarity. Hey, if you got value out of this video, do me a favor and hit that like button, and make sure you subscribe so you don't miss the next one. And if you have any questions at all, drop them in the comments below. A real person will get back to you. Until then, safe trading, everyone.